Well, good afternoon, good evening, everybody. Welcome back to Strongman Personal Finance. We got a sponsored video. That's right. Somebody paid me $50 to talk about whatever they wanted me to talk about. In this case, it's a company called Diversified Energy Company. It's a company that has diversified energy, even though most of its revenue comes from natural gas. The vast majority of it does. So we're going to check out the financial statements of this stunk, and I'm going to tell you if it's going to 10x in 5 seconds. I'm just kidding. But if you want a personalized video, all you got to do is send me $50 and I'll talk about anything. I'll react to anything. I just won't do stock price predictions and valuations because that's clownery. So let's go ahead and check out Diversified Energy in this amazing sponsored video. What does this company do? Diversified Energy Company, PLC, ticker symbol DEC. Diversified Energy Company, PLC, make sure we're sharing. Okay, we're sharing. Operates as an independent owner and operator of producing natural gas and oil wells, primarily in the Appalachian Basin. Yeah, man, come on, squeal like a pig of the United States. The company is involved in the production, marketing, and transportation of natural gas liquids, crude oil, but they mostly do natural gas, and condensates. Its assets consist of natural gas wells and gathering systems located in the states of Tennessee, Kentucky, Virginia, West Virginia, Ohio, Pennsylvania, Oklahoma, Texas, Louisiana. Okay, so basically they have a bunch of natural gas and oil wells, and they acquire these wells, and then they extract the natural gas or oil, and they sell it. That's what they do, okay? So let's go look at the stock price performance. Over the past, well, it looks like it doesn't really show that much data on here. So for the past, I don't know, 9 months, 10 months, the stock is down 37%, but that's really irrelevant. It's got a market capitalization of $315 million. Okay, boyos. Even though this is not technically a penny stock because of the price, this is a very small market cap company. Very small market. And just think about the business, okay? They acquire wells. I mean, they're already, most of them are already like pre-operational, but if they're pre-operational, they're probably going to pay more than acquiring something that's unexplored. Like it's kind of inherently speculative, you know, like they're buying wells. Hopefully they pay a good price for the oil or natural gas they're able to get out of the ground. And guess what? Their business is all based on commodity prices, okay? You got to almost like predict the boom and bust cycles. Like if you think that natural gas prices are going to explode in the next couple of years or the next couple of months or whatever, you think oil is going to explode in the next couple of months, well, then you might, maybe consider buying this, because if those prices go up, this company is going to make a lot of freaking money. But these commodities go through boom and bust cycles, and you kind of have to like know what's going on to make money from a company like this. Okay. So they got revenue of $699 million and trailing net income of $143 million. Now, I suspect that this company has very, very, very volatile earnings, and it has a volatile dividend. So the dividend yield here says 10.44%. However, their most recent dividend, I think, was 29 cents. They've massively cut their dividend. So basically, when natural gas and oil goes up, this company probably has a windfall of earnings, and then it massively increases the dividend. And then if natural gas and oil prices come back down, they got to cut the dividend because they're not making as much profit. Okay, so it's boom and bust, and you can clearly see that. So this is like, Willy Wonka company. So you can see it's like they don't have quarterly reports. They have half year, because we're British and we do half years. So look at the revenue. Okay. Very, 100 million, 150 million, 200 million in the first couple of quarters starting in 2020. And then a massive spike in revenue in 2022, late 2022. Why is that? Well, I went and pulled up the natural gas prices. Oh, look at that. Look what happened to natural gas. It massively spiked back in 2022. Probably because of, you know what I'm talking about. I don't know if I can talk about it, but one country went into another country and they talk like this. Okay. And maybe that's why this went up. I don't know. That's just a guess. Okay. But natural gas prices went up. This company, Diversified Energy, had a windfall. And then the prices crashed back down. And oh, look, now the revenue's gone down. So you're literally just trying to guess if the future natural gas price. That's basically what you do when you buy a company like this. It's as simple as that, really. So, like I said, revenue is basically based on the price of natural gas. Where's the dividend per share? So you see the dividend was massively slashed. Okay. Why is that? Well, they probably had a collapse in earnings because of a collapse on the price of natural gas. Okay. Because of the babushkas. Let's see. Profit margin. Oh, this company barely, basically swings between profitability and non-profitability because of the swings in commodity prices. That's what this company is. Okay. Let's go ahead. And so I saw this. So they did a share registration. They're trying to issue 2.2 million ordinary shares. Basically, it seems like they issue shares and they use, instead of debt, probably. My hard drive is not 91% full. Get out of here. They issue shares and they use that money to acquire freaking more wells. Let's see their acquisition history, or let's see what they issue. Do they issue mostly debt? Okay, well, they issue debt and they issue stock. So not only do so it's a combination. They borrow money, especially in this kind of environment. That's a little concerning. And they issue stock to raise money to acquire properties or to acquire wells. Okay. So let's go ahead and look at the financial statements, bro. Here's the financial statements, bro. Diversified Energy Company and its wholly owned subsidiaries is an strong independent Z-Snap energy company engaged in the production, marketing, and transportation of primarily natural gas. That is true. Financial and operating results for the last 6 months, because Willy Wonka. Net income of $16 million, representing a decrease of 98%. Just a 98% decrease because commodity prices, when compared to net income of $631 million. Diluted earnings per share of 32 cents compared to diluted earnings per share of 13.43 cents last year. Total debt of $1.7 billion compared to $1.5 billion. Okay, so they packed on $150 million of debt, but their operating expenses went down. That's good. Okay. Let's see. They bought back some shares, okay, and they acquired Oak Tree's proportionate interest in East Texas. So they did some acquisitions, okay, and they retired 140 wells. Okay, so interesting stuff here. So let's go ahead and dive in. So I saw this and I was like, oh God, going concern. Whenever you see going concern, what that means is, well, you want to read what it says, but generally, a company is assumed to be a going concern, which means it's assumed to last forever. Because if you're looking at a company's assets and the company's about to get liquidated because they're about to go bankrupt, well, those assets probably aren't going to be worth what you think because they're going to have to sell those off in a fire sale, basically like a liquidation. But you generally assume a company is going to last indefinitely, even though most companies don't. But you assume it's going to last indefinitely. But if there is substantial doubt about a company's ability to continue as a going concern, if you see that statement in there, that's an indicator that this thing might go bankrupt within a year. So I read this and it said, the directors have formed a judgment. The directors, the owners of the company, bro, the board, bruh, at the time of approving the interim condensed, that there's a reasonable expectation that we are sufficiently well-funded to be able to operate as a going concern for the next 12 months. In making this judgment, they have considered the impacts of and severe but plausible consequences arising from our identified principal risks and uncertainties to our activities. Okay, well, I'm reassured because the directors of the company said that it's not going to go bankrupt. Okay, so let's look at the results of operations. So we have the 6 months ended June 30th, 2023 versus the 6 months ended June 30th, 2024. So we can see natural gas revenues are the vast majority of the revenues. Natural gas accounts for How does that even add up? Total product. Does that even add up? Oops. Does that even add up? I don't see how that adds up. 114. Oh, I guess it's some kind of like metric here. I don't even know what the hell this means, to be honest. But 114, 2.8, 0.7, and that somehow equals 135. So I'm not even going to, basically the vast majority of it is natural gas, but we can see there's a 13% decrease in net production of natural gas. That's just production. And let's see, the average selling price of natural gas is down 13%. Okay. And revenue for natural gas is down 38%. So it's a combination of prices coming down and production coming down. Okay. It's only down 38%, bro. But I think what is this? Natural gas liquids and oil is slightly up. Let's see if this adds up. Let me add up the revenue of natural gas. I love when it doesn't seem to add up. 935, 56, 185. Okay, that adds up. So natural gas is 62% of their revenue in the most recent 6 months. And then last year, it was 73%. So basically, natural gas prices went down, so their revenue massively decreased. That's what happened. Their production went down for natural gas, and the prices, the average selling price per whatever metric they use, went down. And then I guess they do derivatives to kind of like hedge, bro. So that's that. Let's see. Okay, we know revenue's down. This is basically you're just guessing what commodities are. Where's the freaking balance sheet? I think this is like so English. So ugly in English. Okay. Here's our liquidity position. We're going to show you our cash and available borrowings and nothing else. But it looks like they have a lot of liquidity. Okay, they have $3.4 million of cash, but they're able to access through a credit facility an additional $103 million of borrowing. So I guess that's liquidity. Our net debt consisted of the following as of the periods presented. So their total debt in the course of 6 months has gone up by 350 million, or 370, 380 million. So it looks like they dipped into their credit facility. They paid off a little bit of these notes. They paid these off. They paid off these notes. They basically issued new notes. They paid off some notes that probably matured, and they issued new notes. And these are probably at higher interest rates. So they've added 370 something million of debt in 6 months. Okay, includes 113 million from the assumption of Oaktree's proportionate share. So I guess this debt came from an acquisition. Okay, includes 83 million in notes payable issued as part of the consideration. Okay, so basically they acquired this Oaktree, and they acquired some of the debt of the company, and they issued a note as part of the consideration or price they paid to buy this Oaktree company. So that explains part of the debt, but it doesn't explain all of it, especially this right here, these ABS 8 notes, $607 million. Okay, asset retirement obligation. So I remember studying this briefly. Basically, all this means is at some point when you use up a well, you're going to have to retire it, and retiring a well has costs. And basically, you kind of like record the cost of that up until the point that you retire it. So that's kind of like it's a liability on the balance sheet. And it's some kind of formula where you like eventually arrive at the ending liability you think it's going to be. That's what an asset retirement obligation is. Okay. Let's see. They're talking about how they calculated it. Net cash provided by operating it. For the 6 months ended June 30th, 2024, net cash provided by operating activities decreased 12 million or 7% when compared to 173 million. The change in net cash was predominantly attributed to the following: a change of our working capital position reflecting the impact of changes in commodity pricing, a $65 million decrease in adjusted EBITDA, and a $17 million decrease in hedge modifications. What do they do with their investing activities? Okay. A decrease for acquisition, associated net of proceeds compared to... Okay, basically they acquired less stuff this year than last year. Off-balance sheet arrangements. We may enter into off-balance sheet arrangements and transactions that give rise to material off-balance sheet obligations. Oh, that's reassuring. As of June 30th, 2024, our material off-balance sheet arrangements of $285 million and $14 million in letters of credit. Oh, it's not on the balance sheet. That's good. I would pay attention to that. Let's see. This is the auditor's report. Nothing has come to our attention that causes us to believe that the interim financial statements are not prepared in accordance with UK adopted international accounting standards, which are annoying, and I'm not learning them. I refuse. Conclusions relating to going concern. Based on our review procedures, which are less extensive than those performed in an audit, blah, 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 nothing has come to our attention to suggest that the directors have inappropriately adopted the going concern. Okay, that's a little reassuring. So it looks like the auditors are saying they're probably not going to go bankrupt. Okay, so they're audited by PwC. Okay, so we have the income statement here. Condensed consolidated statement of comprehensive income. We know revenue's down. We know gross profit's down massively because this is a cyclical company. They barely squeaked an operating profit. And then after the operating profit, they had to pay $60 million of finance costs, accretion of asset retirement obligation. This is like the spreading the cost of having to eventually retire the wells in the future in the current time period, and a loss in early retirement of debt for a total loss of negative $82 million. Look at the swing. They had operating profit of $909 million last year, and now they have operating profit of $2.3 million this year before interest. Before interest, which means they had a loss. So wait, my question to you is, what do you think is going to happen to commodity prices? I mean, that's really it. Okay, here's the balance sheet. God, what page is this on? 16. Oh, I guess that's not too bad. All right. Oh, and here we go with this stupid British crap. So they have the long-term assets on top. Let's look at short-term assets. Yeah, they're very cash light, man. Look at that. They have $3.4 million of cash, $180 million of trade receivables. Basically, it looks like these are the two liquid amounts. Basically, receivables is what you should be collecting from, people that you've sold stuff to. But they don't really carry a lot of cash. I mean, maybe that's just normal for them. So their liquid current assets, if we exclude restricted cash and derivative financial instruments, are $183 million. And their short-term debts are $657 million. So that's a little concerning. Okay. I guess, somehow with a very bad current ratio, they're going to survive. Is this normal for this company? That's not a comforting stat right there. Do they even have the current ratio on this? Where's it at? I don't even freaking see it. Did they get rid of the current ratio? There we go. Okay, so their current ratio is, been hovering around 0.44, 0.3. Their quick ratio has been steadily dropping. The quick ratio represents liquid cash. It's cash, accounts receivable, and marketable securities versus current debts. That's the ratio. You divide all the current assets by the current liabilities. And they operate very cash light. That's what this business does, that makes me not comfortable. But it's your stunk. Okay. Let's see. Long-term assets. So They spent $2.7 billion on natural gas and oil properties, $455 million of property, plant, equipment. So these are the two major assets, long-term assets on their balance sheet. Most of their spending has gone into natural gas and oil properties. So that adds up to a total of $3 billion and change versus long-term debt of $2.6 billion. So not the worst. So if you look at their long-term debt, it's asset retirement obligations. This is the cost they expect to pay to retire the wells in the future. Leases, this is whatever you're leasing. Borrowings, this is debt. Deferred tax liability, this is taxes they expect to pay in the future, but that can always change. Derivative financial instruments. What is that? Probably like hedges on futures or something. But I mean, overall, like they're not massively underwater. As long as these assets that they acquired continue to produce oil and natural gas, I mean, it's not the end of the world. Now, we could see that there's an increase. They basically they spent about $200 million and change buying more natural gas and oil properties. They didn't really buy any new plant and equipment. And they recognized a deferred tax asset. So a deferred tax asset is taxes that you expect to save in the future, but that could always change based on changes in tax law. So when you see a deferred tax asset, that's basically like almost a guess of taxes they think they might save at some point in the distant future. So I wouldn't even factor that in, to be honest, because it's kind of a guess. But I mean, their long-term debt to long-term assets doesn't seem to be that bad. What I don't like, but it seems to be a normal for this business, is they're very cash light. Very, very cash light. They have $3.5 million of cash versus an F ton of debts due within the next year. But I guess they work it out. I guess they have enough cash flow to cover those debts as they're due. So, all right, let's see. There's a statement of cash flows. Here we go. Income tax benefit. Let's see. Gain or loss on fair value adjustments of money. Okay, so they recorded an $80 million loss on derivatives. Let's see. Finance costs. Yeah, there's not a really big change in cash flow year over year. And it looks like, yeah, big difference was in the first 6 months of the prior year, they paid off a ton of short-term debts within that first 6 months, whereas this year they didn't nearly pay as many. So that's a huge swing. That's why the cash flows look similar, even though it was a lot more profitable. And a big part of that profit from last year was because of a loss on fair value adjustments. A gain on fair value adjustments of derivatives. So that's a big part of why they had profits from last year. That's the only reason they had a profit, it looks like, to be honest. So you got to be careful when you're looking at this company's profit and loss, because they have these derivative contracts, futures contracts, or whatever they freaking do. And those can result in massive gains and losses on the income statement. What I would focus on is where you think commodity prices are going to go. That's what ultimately matters with this company. You want to make sure it doesn't go bankrupt. And you want to kind of just guess what commodity prices are. Let's see. So yeah, that's pretty much it. I mean, they buy natural gas and oil wells and they take it out of the ground and they ship it off. Bada bing, bada boom. All right, let's do some comments. Man, there's a lot of comments. I'm not doing all these comments. I need to buy a review from Strong Bad. Dang right you do. If you want a sponsored video, see the pinned comment at the conclusion of this. Send me your money, and I will make a video about whatever you want. Somebody send me a reaction request. All I've been getting is like penny stocks. Yeah, hit the like button. Meet Kevin is streaming. Our hero and genius. Let's see. Drill, baby, drill. You're going to talk about you maybe if I have time. Please point. I'm in my underwear right now. You want to see my undies? Yeah, it's quite speculative having a dividend is not desirable. They would need. I mean, you can't even predict where the dividend's going to go because you're trying to predict natural gas prices, basically. That's what you're doing with this company. We need more data. I know. I'm so busy. You guys have no idea how busy I am. I stay far away from boomer stocks that have split 20 times. Feel like it's a waste, blah, 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 blah. All right, guys, just way too many freaking comments. If you guys want to sponsor videos, see the pinned comment below. Buy my book, Stop Being a Broke Loser. If you want me to tutor you, $75 an hour, I'm a CPA. I can teach you accounting. Have a wonderful day. Cheers.